Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us once again, a hard guy to book, but a lot of folks have been asking for him. I probably had a dozen personal emails and many comments on the site saying, when are you going to get John Williams of ShadowStats.com back on? Well, today's the day, folks. John Williams of ShadowStats.com, welcome to USA Watchdog.
Thank you, Greg. Great to be with you.
Well, you have made some big predictions in the past, and one of your predictions is, the beginning of hyperinflation sometime in 2014. How does this budget battle, debate, debacle, debt ceiling, budget, how does this going to play in with your prediction for sometime in next year, the beginning of hyperinflation in 2014?
Well, it's pretty much in line with what I've been looking for. The issue here, very simply, is the long-term solvency of the United States of America. The global markets know that the U.S. is in serious trouble. If you look at our annual deficit, using generally accepted accounting principles, and you take the net present value, how much cash do you need in hand to cover the unfunded liabilities for Social Security and Medicare, instead of seeing what was a $1 trillion deficit, cash-based deficit back in 2012, that was 6.6 trillion. This year's deficit had all sorts of gimmicks in it. The cash-based, we haven't seen the gap-based one. That doesn't come out until December, unless the Treasury Secretary is skipping town like the last one did, and then they delay it. But come this next one, I expect it'll be worse than the 6.6 trillion we saw last year, and that is that's beyond containment. You can't balance that in a given year. You could raise taxes, income taxes, take 100% of wages and salaries. You'd still be in deficit. On the other side, you could cut every penny of government spending, except for Social Security and Medicare, and you'd still be in deficit. The problem here is that you can't balance the deficit, and with this get to the point that the U.S. has a stable economic future by raising taxes, or by avoiding the social programs and just hitting hard spending such as military spending. You have to have some spending cuts. You've got to have a recasting of Medicare, Social Security, this Healthcare Act, so that each one is self-sustaining. And if you can do that and get rid of this gap-based deficit that is going to kill us, and indeed this is the basis for the longer-range hyperinflation outlook, we're going to be in very serious trouble in this next year, because the global markets know this is happening. They've been patient. This came out of the 2008 crisis. Let me back off. Before the 2008 crisis, because of the way the deficit, the fiscal conditions had been handled by the government in terms of spending, such as adding in this big adjustment to Medicare with the prescription drug program, but not funding it. At that point in time, back in 2004, they doubled the total obligations of the United States. They never funded it. That was a circumstance that effectively doomed us to a long-term hyperinflation. The hyperinflation in the long term, more towards the end of this decade. But the crisis that took place in 2008, where the Fed had to step in and flood the system with extraordinary liquidity to keep it from collapsing, to keep the banking system from collapsing, that brought the time forecast, the time horizon for hyperinflation much closer into 2014. Now we're in a circumstance, if we were to avoid it, I think we've gone beyond the point where it can be avoided. The government would have to balance its deficit, would have to take decisive action to take care of the long-term liquidity problems as well as the short-term liquidity problems. They're not doing it. All this talk that we're seeing, all this debate back and forth, the message very simply particularly from the administration where there's nothing here to negotiate, is that they're not going to address the long-term solvency problems of the United States. That's going to trigger a massive decline in the dollar in the not-too-distant future, and that in turn will give us the early stages of the hyperinflation in this next year.
Well, so there's no political appetite. They can't hardly agree on a 3 or 4 month deal, which is what's on the table. That's what it's been cut down to. They can't hardly agree to 3 or 4 months, keeping the government going and the deficit ceiling until January, February. What you're talking about is big tax increases, big cuts, lots of pain. There's no political appetite for that on either side of the aisle, is there?
No, there's no political appetite for it. It's more, the pain is more going to be in the spending cuts, because you're at a point with the taxes that the more you raise the taxes now, the less response you're going to see in revenues, because the higher taxes slow the economy.
Well, Go ahead. No, finish your thought. Sorry.
What we're seeing here is the third or fourth leg of the negotiations that they couldn't complete back in 2011. Back then, they couldn't reach an agreement, so they threw things off till after the election, the presidential election, and they put in the sequestration to handle things they couldn't agree on otherwise, and the debt ceiling. Again, that was all going to be addressed, but as each crisis began to unfold, they just pushed it further into the future. And so we've moved from the middle of 2011 to what is now approaching the end of 2013. This has been installed for 2 years. Any more delay here, the rest of the world, and you're beginning to see it in comments of some of our big trading partners and some big holders of U.S. bonds. What's going on in the United States? You've got to do something here to secure your financial future.
One of the most vocal you're talking about is China, saying we should de-Americanize the globe, and they're saying that Christine Lagarde at the IMF is saying this would destabilize the world if the United States can't get its act together. We are the world's reserve currency. Is that what you're talking about? Things like that?
That's what I'm talking about, and indeed the dollar is a world's reserve currency, but it's not going to be for long if we don't get things straightened out here. And again, you're already seeing the pressure to move the dollar out of reserve status. And if that happens, we're going to see, again, that will just accelerate the pace of inflation. As the dollar weakens here, and that's where the global markets generally will attack this problem or lack of our nation addressing the issues. We'll see heavy selling of the dollar. That in turn would be exacerbated terribly by the dollar losing its reserve currency status. If that happens, the dollar weakens. What happens in the markets is you see spiking commodity prices, such as oil, such as gasoline. And people in the last year or so have had a little flavor of what higher gasoline prices can be like. We haven't seen anything like what's ahead there if the dollar comes under heavy selling pressure.
Well, I mean, what I think is bizarre, and I brought this up on my channel many times, they got this sequestration, which they're fighting over stopping, $85 billion a year.
Yes.
But we're handing out to the banks in this $85 billion a month, just to the banks, $40 billion a month. And, we could save $500 billion a year if we cut off buying these mistakes and fraud of bankers. Why isn't anybody talking about that? I mean, isn't that too big, too stupid to be stupid, as Jim Sinclair over at JS Mindset says? Isn't that too stupid to be stupid that nobody wants to address? We're handing the banks $500 billion a year, but they'll fight tooth and nail over $85 billion in sequestration for a year?
Well, it's a devil's choice. We need the banking system if our economy is going to function. And you look at it from the Fed standpoint, its primary function in life is not to give us a stable economy and low inflation. Its primary function is to keep the banking system stable. It's owned by the banks. It's a private institution. It's not a federal institution, despite its name. It's not been doing a very good job. The banks are no better off really than they were back at the crisis of 2008. 2008, we almost had a collapse of the system. They weren't kidding about that. The different ways it could have gone, but they stepped in to prevent a collapse of the banking system. They spent extraordinary sums of money, pumped literally trillions of dollars of liquidity into the system. Here we are now, what, five years after that? The economy has not recovered. I know officially it has, but if you want to talk about it, I'll tell you why it hasn't. The banking system's still in trouble, and now our budget deficit, which has just been blown apart by all this, is at the brink of giving us a great crisis with the U.S. dollar, which will give us the hyperinflation, the early stages of it. The dollar gets dumped as foreign investors dump their holdings of U.S. treasuries and such. You'll see the inflation picking up very rapidly.
The economy's not getting better. Briefly, the employment situation is not getting better. People aren't investing. I mean, that's really what they say the employment is 7.3%, 7.6%, somewhere in that neighborhood. I think it's a phony number, so I don't even really, try to keep track of that. It's really much higher, right? Underemployment?
Oh, yes. Well, the last number that was published, which was back in August, for the month of August, 7.3%, that headline number. That has no relationship to common experience because they define people who have not looked for work in the last 4 weeks as being discouraged workers, or they just don't count them at all. They end up in broader measures. What's happened, the reason the unemployment is at that level, and it's actually off its peak, is that instead of finding jobs, which would be a healthy way of having the unemployment rate drop, is that people haven't been able to find jobs. They become long-term unemployed. They're discouraged. They don't look for work. The government doesn't count them, but they very much consider themselves being unemployed. They want a job. They take the job if it were available. And if you look at the government's broader measure, that's up around 14%, which includes some of those discouraged workers. But if they've been discouraged for a year, the government doesn't count them at all. I estimate that, and if you put that back in, you're looking at unemployment up around 23%, which is at the high of the cycle. It's not gotten better at all. A counterpart to that is household income. If you look at median household income, the middle level, adjusted for inflation, it's basically at the low of the cycle. The economy started recovering in June of 2009 for the government. And if you look at the GDP numbers, it recovered its pre-recession high. It's now 5-6% above where it was then. But household income in June of 2009 continued to plummet. We're seeing levels of household income now that haven't been seen since the late 1960s.
Is part of that Obamacare and people going to, oops, now you're 29 and a half hours or 29 hours, you're no longer a 40-hour-a-week employee, we're not going to give you health care? Is part of that? That's
part of it. That and the loss of higher-paying production jobs to offshore competition. And if the consumer that doesn't have a growing income, net of inflation, there's no way you're going to have growing consumption net of inflation. Income fuels consumption. The consumption accounts for more than 70% of the GDP. Now, there are times when you can buy growth from the future through debt expansion, so that people are not making enough money to spend enough to prop the economy. The Fed might encourage people to take on more debt, which is what Greenspan did. He did that very deliberately because he saw this problem with consumer income has been a long-term one. So he encouraged consumers to take on debt upon debt, and that's what crashed in 2008. That income growth is that debt growth is no longer available to the consumer. So that
home equity lines, ATMs for their houses, stuff like that.
They have to rely on the income. They're not getting the income growth. You're not going to see growth in the economy until growth in income picks up, which is not about to happen. There's nothing being done to address that, or until you see significant loosening up of credit, which is not happening.
Well, I'm going to go back to this to your big forecast sometime in 2014. Now, you're saying that this is a can kick. There's no big deal on they don't have a big deal. They're kicking the can, and it's tink, 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 tink. At some point, doesn't it go tink, tink, and go off the cliff? I mean, what you're saying is that given just what we're seeing and what we've been seeing since 2011, and the machinations and the sequestration and the tooth and nail partisan fighting, and nobody's addressing the big problems, aren't we simply headed for a hyperinflationary crash?
Yes. I see that happening, and I think we're basically at the point where they can't kick the can further down the road.
Okay, this is it. I mean, this is
it. I mean, they're going to try. They're going to keep trying until they can't do it anymore. But where they're going to find out they can't do it anymore is in the response in the markets, and very specifically in the currency markets. I think we're going to see, you'll get all sorts of spasms in the markets as these stories. Oh, we've got a deal. We don't have a deal. This is going to happen. That's going to happen. Oh, we're going to talk about this over the next month or two. You have the plunge protection team that comes in, and that's not anyone's fantasy. They're there all the time to keep the markets stable. So the president's working group on the markets.
They're manipulating stocks, bonds, interest rates, gold, silver. They're manipulating everything, aren't they?
They intervene in gold. They intervene in the currency markets. They intervene in the oil markets. They intervene wherever they have to in order to make things go the way they would like them to go. The point is that with that all there as buffers and the dollar comes under selling pressure, you'll see actions to prop up the dollar. Again, there'll be all sorts of intervention. I think we're at a basic turning point, and going forward from here, you're generally going to see a weaker dollar. And generally, it's going to get much weaker. You're going to have a dollar panic. I can't give you the timing on that, but it's been brought a lot closer by what's happened here in the last couple of weeks. What we're seeing now is part of the trigger process. This will start us on the road to a much weaker dollar, and with that will come the early stages of the hyperinflation. And as the world dumps its dollar assets, the treasuries and such, the Fed will have no choice but to buy those up, and again, that'll really start to fuel the inflation. The dollar loses its reserve status, you're off to the races.
You're saying that the trigger point is other countries, China, India, Russia. Putin, I think, was quoted saying that everybody knows the money printing can't go on, and everybody knows it, and which I think is kind of ominous. I mean, I think people are going to they don't really hate America. They're just going to protect themselves from the inflation. Am I wrong?
Well, they have either inflation if they're tied to the dollar, or losing the value of where they have their money invested if they're holding dollars, which would say be the case for China. The reason you're getting all this noise right now is that these people are seeing they're responding to what our government is doing or not doing. Now, the government's been in crisis here for a couple of weeks. You've had a shutdown of the government operations. Now we're on the brink of the hitting the debt ceiling for beyond which some cutting of spending has to take place. I mean, they're not going to be able to raise the debt anymore, so they're going to be short in paying some obligations.
So real cuts are going to have to take place. They won't have the money.
If this all that's happening that in terms of a settlement, and even with a settlement, all the things that will happen are going to come up again in the next couple of months. If what I'm hearing is accurate, we're going to extend the crisis another 2 months. This is a circumstance where if I were a major rating agency, and you've got 3 of them in the United States, Standard & Poor's took courageous action back in 2009, and they downgraded the U.S. from its AAA status to AA. Now, when you look at a rating is just it's an assessment, it's an opinion as to the risk of default, generally within the next year, and it's on a relative basis. The benchmark all along here has been U.S. Treasuries. That was the safest instrument that could exist. But back in 2009, with the threats of default, all of a sudden the risk of default starts to pick up, and S&P downgraded the U.S. debt. Now Moody's and Fitch are the two other major ones. Moody's has made comments that we think everything's okay at this point. We think they're going to pay their bills. That only happens under certain circumstances. One, the Treasury would have a private conversation with the rating agencies. That happens all the time. But the Treasury would have assured the rating agencies that irrespective of what happens here, we're not going to default on the debt. We're not going to not make an interest payment or not make a debt payment.
And we're not going to default on the debt, even if we hit the ceiling.
Default on the debt. If they reassure the rating agencies on that, the rating agencies are much more inclined to not do anything. But then you hear the Treasury Secretary also saying before Congress, I can't guarantee how that I can prioritize the payments here to do that. Well, there he's raising the doubt of whether or not the U.S. would actually default. That's the type of thing that triggers a downgrade. They're very dangerous games that are being played here, and it is. I don't know how it ends up, but I would look what I would look for here, even though we don't default, and I'd be very surprised if the U.S. actually defaulted. It would take a deliberate action or deliberate inaction on the part of the current administration for us to default. If you have a default, it's because someone in Washington wants that to happen. But if we're not paying all our bills, again, from a credit rating agency standpoint, this suggests that there's some risk of default. It's no longer zero. And if we get a downgrade here, that will accelerate the process of the dollar selling and moving us again into the early stages of hyperinflation.
Well, when you say early stages of hyperinflation, and let's say we're into it by maybe a quarter of the way, what do gas prices look like for the common person?
It'll be substantially higher. I can't give you hard
like
numbers.
Like a buck a gallon more. All of a sudden, overnight, you're paying an extra $1 a gallon.
See 10 gallons, you'd see 20 gallons, or $10 a gallon, you'd see $20 a gallon. At some point, you see $100,000 per gallon. If you look at what happened in Germany in the 20s, and this is where it starts to accelerate, and the inflation gets very bad very quickly because people don't want to hold the currency. They try and grab some hard asset. A classic story is someone would go into a restaurant one evening and have a wonderful dinner and a very expensive bottle of wine. The next morning, that empty bottle of wine would be worth more as scrap glass than it had been worth the night before, filled with the most expensive of wines. That's how rapidly it deteriorates. So initially, you'll see $4, $5, $6 per gallon it'll eventually go to 10, but when it starts to accelerate, that's when you got to watch for the hyperinflation, because as that starts to pick up and feed, and people have to make all sorts of arrangements to make more money or get more money, and wages start to rise with this, it becomes a self-feeding cycle.
And what about gold? You said tangible assets. I suspect art, diamonds, land, a paid-for house, gold and silver. There's a lot of chatter on there about how the government is suppressing. I mean, I think last week 500,000 ounces of gold hit the market in a very short amount of time, which drove the price down. If you were trying to sell your commodity and make some money, you wouldn't want to, all of a sudden take a $30, $40, $50 a hit, an ounce hit. What do you tell people who are holding precious metals? Should they go ahead and sell now and get some fiat dollars, or what would you tell people about gold and silver in the future and what you think will happen in this environment, which looks like we're going to crash, according to you?
What I look at very simply here, I'm an economist. I'm not an investment advisor, but generally I can give you a broad picture of where we are, and we're at a point where people, and we have been at this point for some time, that you need to be looking at preserving the purchasing power of your wealth, your assets. You want to preserve your wealth and assets. gold is a primary hedge there. Now, gold, if it's at $1,800 or $1,200 at this point, I mean, maybe you bought it at $1,800 and then $1,200. That doesn't make much difference. You have to hold it into the crisis to have the safety effect of it. And when gold's at $100,000 an ounce or $1 million an ounce, it's not that you've made all that money. It's that you've preserved the purchasing power of the assets that you had. And a difference of a couple of $100 is not going to make any difference. It's a matter of holding the gold through the crisis.
You're saying that
silver, and I'm talking physical gold, physical silver.
You're saying that forget about the price right now. It's immaterial. $500, $600, $700 spread, nothing. It's immaterial. It's possession, not price. Is that what you're saying?
Yeah. If you'll end up with an average cost of God knows what, whether it's $1,500 an ounce or. But the key is to look to preserve the assets, because once you're up to 100,000 an ounce, even there you can still preserve the purchasing power of the assets, but you're going to be dealing with assets that are now worth 100th of what they were worth before.
You're not just saying 100,000 an ounce as some sort of throw out thing. You're saying things could get so bad that $2,000 an ounce gold is going to look very cheap?
Yes, that's what would happen in a hyperinflation. But to say it's cheap, again, you don't look at this as something where you're just making a quick buck on the rise in the price of gold. The rise in the price of gold is reflecting the loss of the purchasing power in the asset with which you use to buy the gold. So if you're buying gold with dollars, if gold is up to 100,000, let's say from 1,000, it means that the dollar, what was once worth a dollar, is now worth a penny in the currency. So you haven't made a big profit. What you've done is you've preserved the purchasing power of your assets. It's a preservation of wealth here that people have to consider. And
you're suggesting that if you don't have some sort of tangible assets and you have paper, you're going to get wiped out. That's all there's to it. Is that what you're saying?
But if your assets are all denominated in U.S. dollars and they're not hard assets, I mean, like treasury bills or bonds or something like that, those will become worthless in a hyperinflation.
And the stock market, how's that going to do?
Stocks are something of a hedge against inflation, but when you get into hyperinflation, nothing's going to adjust quickly enough to get up there. You don't want to be in stocks during this type of circumstance.
Wouldn't this cause an economic collapse? What you're talking about, isn't that going to be a systemic? Isn't what we were fearing in 2008 going to absolutely hit us? Some people say worse because the banks are bigger and more leveraged. Aren't you talking about a collapse, or am I wrong?
Well, you're likely going to see something like that. But let me contrast it with Zimbabwe, with former Rhodesia, I believe. They had the worst hyperinflation anyone's ever seen. Where if you took an original $2 bill, and if you could have come up with a $2 bill in their last iteration of the currency and tried to make a pile of those equal to the original $2 bill, that a pile of the new currency would literally reach from here to the Andromeda galaxy, light years high. Not enough trees on the face of the earth to print the currency. Yet this happened over several years. People survived. Their economy functioned. It was not a good time, but the economy did not shut down. The reason it didn't shut down was that the average person was able to put their money into a hard asset. In this case, had a black market in U.S. dollars. So I'd pay you your wage. You'd immediately go to the black market and convert that to U.S. dollars. Once you had your money in that hard asset, then you could relax a little bit and you could pay your rent. You could buy your groceries. You were okay. We don't have a backup system in the United States. And that has very frightening consequences. Ron Paul, you have a circumstance where he had actually proposed legislation to make gold and silver currency on a par with the paper currency, and that you could exchange between gold and silver and the paper currency without tax consequence, whatever the going rate was in the markets. If you had something like that, that would be a backup that would enable people to continue normal, something akin to normal business activity and commerce. In the circumstance that you don't have something like that, then you have an economic collapse. And what is now, I would contend, a depression would end up as a Great Depression. As the system gets distorted and people don't have the ability to function the way they used to, the paper currency is not worth anything. I don't know how credit card vendors are going to handle things. I mean, what might be a fine credit line on a credit card tonight might not buy you a loaf of bread in the grocery store tomorrow. So this is why you want to get some hard assets.
And do you think there'd be a move back to if something really starts getting ugly? Do you think they'll rush a bill through Congress to have an alternative use of a currency like gold and silver, or would they be forced into doing that?
We're getting into real speculative areas here. I would hope someone would do something like that. But
or do you think it'll happen on its own in the black market?
If this becomes, what I'm talking about becomes more evident to the general public, in which case that would by itself would be something that would tend to accelerate the process along. I would think that maybe someone would try to do that, but certainly the central bank doesn't want that. That being the Fed. That's one reason they keep bashing gold down.
Well, if they start massively selling the dollar, I don't know if the Fed's going to have much power. Those are Federal Reserve notes.
The point is, however that goes, and there are different ways that it can break. It's not a happy circumstance. It most likely would lead to a disruption of the normal flow of commerce, which will slow the economy. I mean, you'll have all sorts of very unhappy circumstances that come from that.
Civil unrest, log lines at the gas station, no food on the grocery stores shelves. Is that what we're looking at?
Those would be among the effects, yes.
All righty, John Williams, thank you for the long interview. I went long today because you haven't been on for a long time. A lot of people have been actually, no kidding, sending me personal emails. Get John Williams on, putting comments on the site. Please get John Williams. Hey, he'd be a good guest. So anyway, that's why I did a long interview with you today, my friend. And thank you so much for coming on. Try to get you on sooner next time and make people happy, all right?
We'll do that, and thank you so much for having me.
All right, John Williams, shadowstats.com. It is a site where you give information to Fortune 500 companies, hedge funds, and individuals can buy your service. You have a free page at shadowstats.com. You can also buy your very detailed research at shadowstats.com. John Williams, once again, thank you very much for joining us here on USAWatchdog.com.
Thank you, Greg.